Alpha beta, how are the two used to evaluate a stock's performance? Hello, I'm Rachel and you're watching Kalkine Media. In today's video, we're going to demystify the concept of alpha versus beta and how these two can be used to evaluate a stock's performance. Alpha and beta are two commonly used terms in the stock market. Investors and traders use the two key measurements to evaluate the historic performance of a stock, fund, or an investment portfolio. While alpha is used to analyze the performance of a stock in comparison to a benchmark index, beta shows the volatility level of a stock price compared to the overall market. A high reading of alpha is considered good by investors and traders. On the other hand, a high beta may be preferred by an investor in growth stocks. It is, though, disliked by investors seeking steady returns and lower risk. Now let us understand the key differences between alpha and beta. Alpha is generally represented in the form of a number in financial reports or pink dailies. Either it is a positive number or a negative number. Now what does that mean? Well, the number indicates the percentage above or below a benchmark index that the stock or fund price achieved. A reading of 4 indicates that the stock or the fund did 4% better than the index. A negative reading of 5% would mean that the index fared 5% worse than the index. In case of an investment, an alpha of 2 would mean that the investment outperformed its benchmark index by 2%. A negative reading of 2 would mean the investment underperformed its benchmark index by 2%. A 0 alpha means that the stock return matched the benchmark index. Being an historical number, alpha can only track a stock's performance over time. It cannot estimate its future performance. Therefore, individual investors can gauge how a stock or fund may perform with respect to its peers or the overall market. Professional portfolio managers use a capital asset pricing model to estimate the potential returns of an investment portfolio. In the case of an investment portfolio earning just 4%, that's despite the capital asset pricing model analysis indicating a 5% return based on risk, the alpha would be minus 1%. Now for the key takeaways. Investment managers focus on diversifying their investment portfolios to generate higher alpha. Alpha represents the value a portfolio manager adds or subtracts from a fund's return. On the other hand, as we have already discussed, beta indicates the volatility of a stock, fund, or a stock portfolio compared to the overall market. The measurement is used by investors to know about the volatility associated with a stock. It gives them an idea if the stock is worth the risk to invest. Beta has a baseline of number 1. It shows that the stock's price moves exactly in the same direction as the market. A beta of less than 1 indicates that the stock is less volatile in the market, and vice versa. In the case of a reading of 1.5%, the stock is said to be 50% more volatile than the market. Beta is also a historical number and does not help to predict a stock's future performance. Tech stocks are known to give higher returns to investors, but they do come with more risks. Meanwhile, investors with lower risk-taking potential, such as retirees who seek steady income, go for stocks with lower beta. On the other hand, risk-tolerant investors seeking higher returns generally invest in higher beta stocks. Well, thank you for watching. I hope this has given you some insights to the concept of alpha versus beta. If you like this video, please like, comment and share, and subscribe to Kalkine Media's YouTube channel for more interesting insights and information on the markets and beyond. I'm Rachel, signing off for Kalkine Media.